I want to talk to you about how to choose an inventory costing method for your operation this year. Okay, that doesn't matter if you have if you're operating your inventory from a warehouse, from let's say from your own logistics facility, from a third party, from a 3PL provider, or from any other setup that you have. Okay, so here's a prologue to today's conversation. The thing is that there are several methods for determining the cost of your business inventory. So you have methods like FIFO, LIFO, and weighted average cost. But you have way more. You have HIFO, you have LOFO. I'll go more into detail later on. Okay. One thing for sure, when you have inventory, you want to really evaluate the inventory properly because inventory is an asset. Inventory can be a short-term asset or a long-term asset, but usually it's a short-term asset per U.S. GAAP. Okay, so it really understand that you it really makes sense to understand your inventory, how to value it in the inventory valuation. So let me first explain to you real fast what's inventory costing. So inventory costing, also known as inventory valuation, is a process by which your company assigns monetary costs to items in stock. Some of those costs include incidental fees like storage costs or market fluctuation and product prices. Okay, so inventory costing is a component of inventory accounting, a broader set of activities related to managing and reporting inventory. So generally accepted accounting principles, GAAP, US GAAP, and the International Financial Reporting Standards, IFRS, apply to both. And these are standardized accounting rules that prevent companies from overstating cost. Okay. So the two main metrics inventory costing determines are cost of goods sold and ending inventory because the thing is that cost of goods sold goes to the P&L, your profit and loss, and ending inventory balance goes on the balance sheet. So why is inventory costing important? As a business, inventory usually ranks among its most significant assets. So inefficiencies or unwieldy, let's say unwieldy costs can have a ripple effect on the rest of your organization, especially when it comes to the financial aspect of it. So a small adjustment to inventory will trigger a corresponding change in reported income. So inventory costing also provides a certain level of inventory control, which can help reduce total inventory cost and avoid over or under understocking. Okay. Finally, and this is an important element, proper inventory management ensures a business's financial statements, the documents often reviewed by regulators and investors, are accurate and in line with US GAAP and IFRS. So let me talk to you about the methodology here. Here I'll be very granular. I'll show some numbers on the screen so you have a clear idea what I'm speaking about. So what are the common inventory costing methods? Okay, so you have a lot of them. I will start with FIFO. So with the first in first out, FIFO stands for first in first out. So with the FIFO inventory costing method, the oldest inventory cost, in other words, the first in, is actually sold or used first. The method assumes that cost of goods sold corresponds with assets assigned the oldest cost. An accountant then matches remaining inventory asset, in other words, the ending inventory, against assets more recently purchased or manufactured. So let me really illustrate this with an example. I'm going to put this on the screen, okay? So an electronics store starts with an inventory of 100 smartphones at a cost of $200 each. So the initial inventory you can see on the screen equal 100 units times $200. So that's $20,000. So let's say the store makes a subsequent purchase of 50 smartphones at a cost of 220 each. So the cost of new inventory is, as you can see this on the screen, 50 units times 220. That's 11,000. So the store then sells 120 smartphones. So calculating cost of goods sold using the FIFO methods, you actually would allocate the first 100 units sold to the original cost of $200 each, followed by the 20 allocated to the more recent cost. So you can see this on the screen. Cost of goods sold actually equals 100 units times 200 plus 20 units times 220, and that's equal to 24,000. So to calculate ending inventory cost using FIFO, you would allocate the remaining unsold 30 smartphones to the more recent inventory cost. So ending inventory is equal to 30 units times 220, and that's equal to 6,600. What about LIFO? So the last in, last out inventory costing method records the most recently purchased inventory or produced items. In other words, the last in as sold first. So the cost of this recent inventory purchases is actually expensed as a cost of goods sold, while the lower cost of old products is reported as ending inventory. So let me actually use the previous example and really continue and really illustrate what I mean here. So if our electronics store starts again with an inventory of 100 smartphones at a cost of $200 each, the beginning inventory will be initial inventory 100 units times 200 equals 20,000. In the next purchase, the store buys 50 more smartphones once again at $220 each. So the cost of new inventory equals 11,000. Again, I'm putting this on the screen so it's pretty clear. Again, the store sells 120 smartphones. So using the LIFO method, the last 50 smartphones from the recent purchase are assumed to be the first inventory sold, followed by the first 70 from the initial inventory. So the cost of goods sold will be $25,000. I'm showing this on the screen so you have a clear idea how the calculation actually was actually made. So to calculate ending inventory, the remaining 30 unsold smartphones are allocated to the older cost amount. So ending inventory equal 30 units times 200, and that equals 6,000. Let me talk to you now about the weighted average. So weighted average is another cost like inventory evaluation method. So weighted average cost inventory costing is a method that uses average unit cost to calculate cost of goods sold and ending inventory. That average cost is calculated actually using a simple averaging formula. So nothing really complicated here. So FIFO and LIFO are more, let's say, advanced, but weighted average is pretty simple. So let me use the same example that I used earlier. Our initial inventory is the same, right? 20,000. Our cost of new inventory also remains the same at 11,000. Once again, let's say the store sells 120 smartphones. The calculation for weighted average cost is as follows. Total cost, initial inventory plus cost of new inventory, that's 31,000, right? 20,000 plus 11,000 equal 31,000. So the weighted average cost per unit, so you take the total cost divided by the total units. So you're looking at 31,000 divided by 150 units, and that equals $206.67. So with weighted average cost calculated, we can then proceed to determine cost of goods sold and ending inventory. So cost of goods sold, 120 units times the average, 206.67 cents, approximately 24,800. And the ending inventory, you're looking at 30 units times the $206.67, approximately 6,200. You also have another method that's the specific identification. So the specific identification method actually uniquely identifies and assigns the actual cost of each unit, usually using item serial number. So you need to serialize your inventory to be able to use the specific identification. So basically, the result is a more precise calculation of cost of goods sold and ending inventory. However, it's actually difficult to achieve unless items are distinct and their costs are easily traceable. Remember, specific identification is not a cost flow assumption, but it is still a GAAP and IFRS accepted technique for inventory costing. So let's use a different example. Perhaps an online store specializing in buying and reselling handmade garments. You would calculate cost of goods sold by adding the specific cost of each distinct garment sold. Likewise, you would calculate the ending inventory by adding the specific cost of each distinct garment that remains in inventory. So the cost of goods sold here will be a little more different. you have cost of item 1 plus cost of item 2 plus cost of item 3, because those are specific costs actually. So ending inventory will be equal to cost of item A plus cost of item B plus cost of item C. It sounds simple, but if your inventory is large or items are not easily distinguishable from one another with precisely documented cost, the specific identification inventory method can quickly become really, really expensive and onerous. Let me talk to you now about HIFO. So HIFO is pretty interesting. So HIFO actually stands for highest in, first out. Okay, highest in, first out. So this inventory costing method assumes that a company will sell its highest cost inventory items first. So if our initial inventory is $5,000, reflecting 50 inventory units, and our cost of new inventory is 5,500, this reflects an additional 50 units, and customers purchase 60 units, the cost of goods sold will then become 6,500. Why? Because 50 units times 110 plus 10 units times 100 equal $6,500. Ending inventory, you are looking at 40 units times 100, and that equals $4,000. By the way, I'm going to put all those things on the screen so you have a clear idea. You can illustrate the examples. Okay, you can illustrate the process. So what about LOFO? LOFO is actually the last method to calculate your inventory cost, and LOFO stands for lowest in, first out. So pretty different from HIFO. So the LOFO method assumes that a company will sell its lowest cost inventory first. So like the FIFO-LIFO dichotomy, LOFO is essentially the opposite of HIFO. So using the earlier numbers, cost of goods sold equal 50 units times 100 plus 10 units times $110. So the cost of goods sold becomes 6,100. And the ending inventory in this case equal 4,400. In other words, 40 units times $110. Okay, so you can see that. So this really wraps up the 6 inventory evaluation methods. The methods that you have if you are thinking about inventory costing. You have a choice. You can choose FIFO. You can choose LIFO. You can choose a weighted average cost. Okay, you can choose a specific identification if you have the serialization process already in place, and you have the tools to actually track the specific products. You also have a HIFO, and finally you have a LOFO. So it's up to you to really see which one works for your operations. Let me go a little more granular in terms of benchmarking here. How do you choose an inventory costing method? Let me first talk to you about when to choose FIFO. One thing for sure, you have to remember that there are different circumstances and business climates that might require selecting one inventory costing method over another, right? I mean, what the method you are choosing is not the same one that your rival is choosing. Everything depends on your niche, depends on your operations, depends on also management objectives. So when should you choose FIFO, for instance? So FIFO is best used when you want to keep pace with the actual physical flow of goods. Let's say you are in an industry where products have a short shelf life, or you want to align cost of goods sold with the actual order of inventory acquisition. So this is actually something that's going to help you actually keep track of the inventory optimization process. And FIFO is also ideal for inflationary environment when prices are rising because it results in lower cost of goods sold and higher reporting profits. So, I mean, for instance, like when there was COVID a couple of years ago, basically a lot of companies in retail, a lot of retail store, they switched back to FIFO to actually benefit, quote unquote, benefit from the inflationary environment. So when should you choose LIFO? Let me talk quickly about that. So LIFO is most suitable when you want to match current cost with current revenues. LIFO assumes that you will sell the most recently acquired inventory first, making it best for your business if you want to reflect the current cost of goods sold. And LIFO can also provide certain tax advantages in some places by reducing a company's taxable income during a period of inflation. So when should you choose weighted average costing? So WACC, weighted average costing, is actually useful when there is no specific class, let's say no specific identification that's actually available for individual units or items, and those items are homogeneous. Okay. The cool thing about WACC is it's pretty straightforward. It's pretty simple. Nothing really complicated. It provides a smooth average cost for inventory items, and the method is appropriate for industries with stable or predictably fluctuating prices and market values. And so WACC actually simplifies record keeping, but it's best when there is no significant inflation or deflation. So once you choose a specific identification, here this method is ideal only when you can uniquely identify and track the cost of individual units. This method is really only suitable for your business if you deal with high value or distinct items like art galleries. So specific identification actually provides the most precise matching of costs with revenues, but depending on the size of your inventory, can be more complex and time consuming to implement. When should you choose HIFO? Well, HIFO helps your company decrease taxable income since the company will realize the highest cost of goods sold. However, HIFO usage is rare and not accepted by GAAP and IFRS. When should you choose LOFO? LOFO is used rarely in multi-layer inventory companies where inventory expenses are extremely low. It's best when you want to maximize your profit on paper. So by selling the cheapest items first, you are left with a more expensive inventory, which could result in higher reported profits. Like HIFO, LOFO is not really GAAP and IFRS accepted, and it can lead to businesses over-reporting profits. So what are the extras here? So the thing is, when you think about inventory costing in general, you have to really understand that the difference between inventory costing and cost of goods sold is that cost of goods sold is a cost measurement determined as part of the inventory costing process. Now, the inventory costing method that's easiest depends on your operations, but overall, based on our analysis, the weighted average method (WACC) is widely considered the easiest inventory costing method because it relies on a simple averaging formula and assumes stable and predictable inputs. So that's really important. And the three main inventory costing methods, if you want to really take this as a takeaway from this show, you have FIFO, you have LIFO, and you have weighted average costing. Okay, so that's really important, especially if you are trying to streamline your operations over time in a very stable and streamlined manner, in a very optimal manner also. So in conclusion, in today's conversation, I spoke to you about inventory costing. So I gave you the prologue, the methodology, the benchmarking, the extras, and now the conclusion. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.